G'day and welcome to the program. My name's Andy Semple. Today I'm going to talk to you about margin lending. Margin lending is a revolving loan facility secured by a portfolio of shares, managed funds and cash. Leverage allows the investor to increase the size of their investment portfolio and potentially earn greater investment returns. It's a flexible line of credit and you only pay interest on what you use. Now let's have a look at what sort of level of gearing you should go to. The first table you can see here illustrates 50% leverage on a, say, $100,000 portfolio. If we go over to the second column now, or the second graph, we'll now look at a portfolio that's leveraged at 70%. So what we mean there is if a portfolio is leveraged at 70%, that means you've got $30,000 of your own equity and you've borrowed another $70,000 from the margin lender, giving you a total of $100,000. If it was 50% geared, it would mean you've got $50,000 in equity and you've borrowed another $50,000 to give you $100,000. Now what's important here is with margin lending is if you get a margin call. Now let's assume that you set up this portfolio geared at 50%, 50 grand down, borrowed the other 50%, and the next day the market dropped 30%. All right, let's look at the numbers here. If the market fell by 30%, your $100,000 share portfolio is now only worth $70,000. Now the margin lender will lend 70% on that, which means you've got collateral now worth, or security value worth, $52,500. The good news is the security value is greater than your loan value. So you've got a very small surplus there of about $2.5 grand. Now, while it's not pretty that your investments are down, you're not in a margin call because you had enough collateral there. Now, on the other hand, let's say you geared yourself at 70% and then the next day the market fell 30%. Now, again, you had a $100,000 share portfolio. That's now worth $70,000. The margin lender will lend at 70% on that portfolio. So it now means your security value is only worth $52,500. But remember, you had a loan of 70. Now that's the problem. See there, margin call of about $17,500. Now that's a problem because you need to come up with either cash or other collateral, usually within 24 hours to meet that margin call. If you don't, then the margin lender has the right to basically close out your account. So it's very, very important if you are going to use margin lending at an absolute maximum, go at 50%. And particularly then if you're investing in stocks that have a high LVR or high leverage from the margin provider, stocks like the banks and BHP, Telstra, Woolworths, they'll usually have an LVR of around 70 or 75%. So it just means you've got some leeway in case the market goes against you. Now, how do we also go about reducing these margin call risks? Well, obviously adopt a lower gearing level than the maximum permitted. Don't capitalise the interest. What that means is if you've borrowed, say, $50,000, the interest that accumulates can be capitalised onto that loan. So it's $50,000 to start. At the end of month one, it might be, say, $50,500. That's capitalising the interest. What you probably want to do is make sure that things like your dividends, or if you're using options, are used to reduce that loan. Obviously, it helps to invest in shares that pay dividends because you'll at least get some sort of a cash flow. And it might be a good idea to, pay an equity contribution on a regular basis into the margin loan too. Think of it like part of your savings plan. And a real good idea is to, get premium incomes from the selling of call options over stocks that are owned in your margin account. Now, let's have a look at this particular leverage buy right example. This is one that I actually put together for our November video. As you can see, it was dated on the 26th of October 2009. And in this case, we illustrated a leverage buy right on ANZ. So we bought 2,000 ANZ shares. We paid $23.73. We also then sold two of the ANZ December 09 24.50 call options, and we received 53 cents. See, what's important there, when we sell the call option, we receive an options premium in, and that options premium can then be used to help reduce your loan. So that's an important thing. Actually, if you think about it, covered call writing is a risk reducing strategy, and it particularly makes a lot of sense if you're utilising a margin lending account. And the rest of that particular table there just illustrates what the potential payoff return was in the case of a leverage buy right on ANZ Bank there. And you can see the numbers that if it was exercised, it looked at a return of around about 11.7%. And if it wasn't exercised based on the purchase price, it gave you a return around about 6.3%. So using leverage in that respect can also enhance your returns, but be mindful. if the market should fall, you can run the risk of getting a margin call as well. Now, considering leverage, now the prime reason to employ margin lending is not for the associated tax reasons. Tax benefits should only be considered as a secondary benefit. Interest incurred on the borrowings is tax deductible. However, please seek independent tax advice before opening up a margin lending account. Now, also, this is very important. Don't draw down the equity in your home and then use that equity as the collateral contribution to open up your margin loan. That's a real no-no. You might have noted in the press Storm Financial, and a lot of poor people lost their homes. That was because they took money out of their home, then went and got a margin loan, so they were really borrowing on borrowing. The market tanked, and basically it was game over. If you're going to use margin lending, make sure the collateral you've got to contribute is your own cash, or you've got existing shares. Don't go and draw the equity out of your home and go and do it. That's a real no-no. You should also consider, if you're taking out a margin loan, whether your future insurance needs are also adequate. You've taken on a new loan as a margin loan. Make sure that you make, in the case of, if you're incapacitated or you get ill, that you've got a means to cover that if the worst happens. Now, particular option strategies incorporating margin lending. If you buy call options and you want to exercise the call option, having a margin lending account is handy, so you've got the funds to pay for that. Obviously, buying shares is what most people use the margin lending facility for. There's the leverage buy rights and strangles. We just showed an example of the one back in October of last year on ANZ, how that was a leverage buy right. And another thing we call leverage put writing. That means when you sell put options, and in the event that you are put the shares, you've got a facility to help pay for that. So there's a quick wrap about margin lending. Just be mindful about the gearing levels that you go into. And until we meet next time, good trading.